Today, a sharp intake of breath as property lending declines again. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. Today I want to discuss the latest ABS mortgage lending stats and link it to our own research on mortgage application declines and the latest global overview from Fitch ratings, which also came out today. More evidence as to why prices will fall further in the months ahead. And by the way, if you get value from our posts, please do consider supporting our work either via Patreon, here is a link, or by making a one-off donation via PayPal. Again, here is a link. We really appreciate the support we receive to help us to continue to make great content. The ABS released their housing finance data to the end of November 2018. The trend estimate for the total value of dwelling finance commitments, excluding alterations and additions, fell 1.1% or $338 million to $29.2 billion. Owner-occupied housing, excluding refinance, fell 1.2% or $167 million to $13.4 billion, and investment housing commitments fell 1.5% or $145 million to $9.5 billion. Refinance loans were down 0.4% or $26 million to $6.2 billion. In trend terms, the number of commitments for owner-occupied housing finance fell 0.2% in November, and in trend terms, the number of commitments for the construction of dwellings fell 0.9%, and the number of commitments for the purchase of new dwellings fell 0.6%, and the number of commitments for the purchase of established dwellings fell 0.1%. Now, looking in more detail at the movements, owner-occupied construction fell 1.5%, down $28 million to $1.8 billion. The purchase of new owner-occupied property fell 1.4%, or $14.9 million, to $1 billion. And the owner-occupied purchase of existing dwellings fell 1.2% or $123 million to $10.6 billion. Investment construction fell 4.3% or $36 million to $0.8 billion. Investment purchases by individuals fell 1.1% or $90 million to $7.9 billion. And investment by other entities, including self-managed super funds, fell 2.4% or $17 million to $0.71 billion. Now, in original terms, the number of first-time buyer commitments as a percentage of total owner-occupied housing finance commitments rose to 18.3% in November, from 18.1% in October. And in November, 10,493 first-time buyers purchased, 356 more than in the previous month. And the number of first-time investors continues to fall as measured by our surveys, with just 350 transactions written in the month, compared with 2,760 a year ago. And the month-on-month data shows the relative changes across the categories. Turning to the original loan data, we see total loans growing by 0.5% in the month, with investor lending down to 33.26% of all loans. Total ADI loans stood at $1.7 trillion, with owner-occupied loans at $1.1 trillion and investment lending at $0.56 trillion. One final cut of the data is to look across the states. And here we look at total owner-occupied lending. And we see a significant fall in New South Wales and Victoria, plus in Queensland, offset only a little by rises in Tasmania, the ACT and South Australia. This, in a nutshell, explains why total credit is falling. Frankly, the major markets of Sydney and Melbourne set the tone for the entire economy. And we don't expect those falls to reverse anytime soon, as credit drives home prices. So the falls will continue, and recent APRA easing will only have a small impact in our view. Finally, it's worth noting that the ABS says November 2018 is the final issue of the Housing Finance Australia and Lending Finance Australia publications. Both publications will be combined into a single, simpler publication called Lending to Households and Businesses. So we'll see what that does to the data next month. So now to Fitch Ratings, who have published their global home, housing and mortgage outlook for 2019. The story appears to be one of falling values in some major centres and more uncertainty economically and politically. For Australia, they expect a national peak-to-trough home price drop of 12% in Australia, with Sydney and Melbourne posting larger declines in 2019. They say overheated home prices in several major cities have been a key theme in recent years, but prices fell or stalled in 2018 in Melbourne, Stockholm, Sydney, Toronto and Vancouver due to government actions to reduce foreign purchases, macroprudential measures and or stretched affordability. Fitch Ratings forecasts home prices to fall in Australia and Sweden in 2019 before stabilising in 2020, modest corrections in China and South Korea, and stalled growth in Canada. They also see regulators actively managing markets through the tightening and loosening of lending standards. High household debt amplifies risk, Fitch says, and household debt to GDP ratios are at or over 100% in Australia, Canada, Denmark, the Netherlands and Norway, and over 85% in New Zealand, South Korea, Sweden and the UK. High household debt makes the wider economies more vulnerable to shocks in the financial sector, and borrowers are more exposed to downturns. Household debt growth has stalled in Denmark and the Netherlands due to affordability constraints and regulatory intervention. The household debt to GDP ratios in Australia, Canada and Norway have stabilised after sharp growth, while they have continued to grow in China and South Korea, albeit at a slower pace. And political uncertainty affects housing. Fitch highlights several cases of political risk in the report, including Brexit, a political appointee to oversee Fannie Mae and Freddie Mac, and the new governments in Latin America. Their impact varies. Their no-deal Brexit scenario analysis suggests price drops in the UK and much slower price growth in Ireland, while uncertainty is already contributing to price falls in London. Less government participation in the US mortgage market could increase mortgage pricing and lead some lenders to reduce product offerings, and in Brazil there is uncertainty regarding the new government's ability to enact market-friendly policies that would support home price growth. Fitch notes in its global economic outlook that cracks are starting to appear in the global growth picture, with China and the Eurozone slowing, further rate increases expected in the USA, stubbornly low core inflation in the Eurozone and Japan, and the dollar's strength putting pressure on emerging markets. These factors contribute to Fitch's view that economic growth is slowing, albeit to a moderate degree, and in many cases from a position of strength. However, their macroeconomic outlook to 2020 for the 24 countries in the report are still mainly stable or improving, which supports their most stable housing and mortgage market evaluations. Fitch does not forecast material increases in arrears in 2019 and 2020 for any country in the report. They expect the impact from weaker growth and generally slow mortgage rate rises to be relatively benign, but there is downside pressure in the medium term from rising rates, fading fiscal stimulus in the US, and weaker growth in China, in the context of still high global debt. A faster than expected tightening in global financial conditions could worsen mortgage performance, they say. And there is mixed impact from rising rates. The speed of mortgage rate rises will vary, with North America expected to post the fastest increases and Japan, and the Eurozone the slowest. The impact will depend on whether mortgages have long-term fixed rates and the macroeconomic backdrop. Highly leveraged markets with large numbers of variable loans, such as Australia, Norway, Sweden and the UK, could see marked deterioration in loan performance should rates rise quickly, and markets with long-term fixed loans such as Belgium, France, Latin America, the Netherlands and the US may see lenders gradually increase their appetite for higher risk borrowers and loan characteristics as their profitability suffers and competition intensifies. Price declines are set to continue in Australia, Fitch says, with a forecast of a national home price decline of an additional 5% in 2019 before above-trend GDP growth and strong net migration should stabilise prices in 2020. The peak-to-trough decline of 6.7% as of December 2018 has been driven by lower investment demand, reflecting macroprudential limits on interest-only and investment lending, and tighter enforcement of lending standards. They expect price declines to continue at a similar pace in 2019 in Sydney and Melbourne, where larger falls have occurred, peak-to-trough declines of 11.1% and 7.2% respectively, as of December 2018. The most expensive quartile of properties has experienced the largest declines, with falls of 9.5%. GDP growth, they say, supports performance, and they forecast loan in arrears over 90 days to increase slightly to 70 basis points by 2020. Properties in possession will take longer to sell as home prices fall, so loans will remain delinquent for longer. Early-stage mortgage arrears, 30 to 90 days in arrears, will be broadly stable in 2019 at 60 basis points, even though lenders have modestly raised mortgage rates for investment and interest-only loans, despite no policy rate increases. Mortgage performance will be supported by slowing but still solid economic growth, decreasing unemployment, and only gradual rising policy and mortgage rates. Risks remain, however, stemming from the highest household debt to GDP ratio in this report at 121%, as at the second quarter 2018. And credit growth is to remain low, with housing credit growth projected to ease further in 2019 to 3.5% from 5.1% year-on-year growth in October 2018. This is due to tightened macroprudential limits and a more conservative interpretation of regulatory guidelines for mortgage servicing in light of the Royal Commission into Misconduct in the Banking, Superannuation and Financial Services industry. Fitch believes that the Commission's final recommendations, due in February, may further reduce credit availability. And investment loan origination has been hit by a limit to investment loan growth of 10%, which was introduced in 2014 and removed in July 2018, for lenders that can prove they have met regulatory requirements for the past 6 months. And the limit on interest-only origination to 30% of new lending, introduced in 2017 and removed from January 2019, for lenders that have met regulatory requirements for the last 6 months, along with foreign investor levies and taxes from state governments. And finally, the latest data from our surveys indicates that around 40% of loan applications for mortgages were rejected in December 2018, compared with 8% a year prior, though on significantly lower absolute volumes. Households often made multiple applications when seeking a loan, and the volume of applications across all segments fell in the lead up to the holidays, and the proportion of rejections fell from 48% the prior month, which was a record. The fall in investor applications is significant as appetite for investment property eases, and the relative volume of refinanced applications remained quite high as people are seeking to reduce their monthly repayments. Non-banking rejections are running at a much lower rate than bank rejections. So let's put all that together. We expect the number of loan applications to lift again in January after the break, but the proportion rejected because of non-compliance with current lending standards will remain high. So as a result, we think total credit growth will continue to ease back, as Fitch said. And as credit drives home prices higher, so the reduced availability of credit will drive prices lower. Our own views, as we discussed in our recent live streams, is a fall of 20 to 30% peak to trough over the next 2 to 3 years, so we are more negative than Fitch. And nothing in this new data, frankly, changes that view. And if you add in heightened global uncertainty and a fading local economy, a deeper fall is still quite possible. As always, if you like what you've seen here today, please share and like the post and add a comment or question. I read them all. And if you want to join the growing band of subscribers who receive alerts when we release new posts, do subscribe now by hitting the subscribe bell. And if you have already subscribed, many thanks. I really appreciate your support and participation. I'm Martin North, the Principal Analyst at Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.